Property prices are set to increase in 2024, but tipped to fall 18% nationwide in the next 12 months. What's actually going on? And which suburbs are set to have the biggest falls? Well, let's start off on the top, and we see ANZ's actually tipped an 18% nationwide slump in property prices. So they've actually come out recently saying that they foresee the fall to happen in house prices in 2022, 2023, before they actually see a rebound in property values in 2024. Now, the banks also projected that this reduction in capacity is mainly due to reduced borrowing power, as we've seen the increase in interest rates have an effect on people's ability to borrow. Now, CoreLogic also says that some high-end regional property markets are already falling and other areas will fall. And as we talked about earlier, the biggest factor that's actually driving lower prices is the reduced borrowing capacity, which has had an effect on recent price falls. So we can see here with each rate cut, your borrowing power that you could once lend from a lender actually reduces. So when we saw the first 3 cuts, so where we are currently at the moment, in the last 4 months, we've seen about a 1.85% increase in rates. So we're at 1.85% cash rate, so somewhere in between here. That's actually reduced your borrowing power in the last 4 months alone by about 20%. Now, depending on where the cash rate gets to, the Reserve Bank predicted at 3.10, ANZ at 3.35. We're actually going to see that the borrowing power from where you could borrow at the start of the year is going to be about 30% less. Now, what we do know is house prices have a direct relation, not on wages. As we can see, wages over the last 20 years has been pretty, standard growth. We can see house prices is more fluctuated by credit. So the bank's ease or difficulty of credit has a very direct correlation to house prices. And we can see that over here when we look at, for example, debt to income ratio. So this is a figure that the bank represents. If you're lending more than 6 times your income, that's usually considered a higher risk loan from the regulator's point of view. We can see the percentage of borrowers back in 2018, 17, that period, we could see we had a high amount of 6 times debt to income ratio. And no doubt during that same period, we saw a peak in values. Once that came down, we can see property values came back down as well. Now, same thing happened recently where debt to income ratio is peaking with more than 20% of borrowers sitting in around that 6 times or over. And as we can see, we've peaked and we're starting to come down as the banks crack down on that debt to income ratio and what they see as riskier lending. Now, the Commonwealth Bank also expected prices to decline by about 15%, which mirrors more or less ANZ's assessment. And ANZ's economists have also said that the tightening rental market, rising immigration, and low unemployment would also help mitigate the decline, but they forecast the reduction in interest rates, which will happen later in 2024 is their prediction, we'll see the market turn around. So they've said that in 2024, we expect to see the beginnings of the recovery of the housing market alongside cuts of the cash rate in the second half. And they're expecting an increase in the market of about 5% for that year. Now, when we look at the market holistically, we definitely have heard Sydney and Melbourne for the 2022 year. It's forecasted to have anywhere from a 10 to 15% price reduction. For most of the other areas, except Hobart and Canberra, we're sort of seeing a pretty neutralized property growth for the year out ending. So, Adelaide maybe up around that 4 or 5%, Brisbane maybe that 2% for 2022. And then we're starting to see that unwinding of sorts, the forecast really for 2023 for anywhere in and around that 15+% for Adelaide, 10+% for Brisbane, Perth 10+% as well. Sydney and Melbourne predicted to be a little bit less, around the 5%, but definitely from what we're seeing here, the interest rate rate hikes are going to have an impact on that. And we might have actually seen the peak in regional prices as we can start to see that coming off the cool, with a lot of people making tree side changes with the COVID really changing the workplace environment where you don't necessarily be needing to be in the office nowadays. Now, we do know Westpac did predict the cash rate to get to the 2.35, Commonwealth Bank saying 2.6, ANZ saying in the high threes as well, sorry, the low threes. And then depending on which bank you're listening to, they're all sort of saying rates will either start to go backwards in the end of latter half of 2023 or at some stage in 2024. What we do know is the medium house values are falling. Based on data, that's going to equate to about 150,000 in the next 12 months. So the medium national value could drop up to $150,000 by the end of the year, according to new data. And we can see, based on ANZ's forecast, at the end of 2023, in somewhere like Sydney, the median value set to reduce by about 204,000. So you're sitting in around that $1.1 million mark. And then Brisbane, same thing, down to the 719,000. I think that's a good thing. I think it's a good thing for home buyers are looking to get in the market that have been struggling and found that really in the last 12 to 24 months, the market moved that quickly, that fast, that their deposits that they had saved up actually wasn't able to get them in at the mark they looked at previously because the values increased so drastically. We always like to think, if we see that slow and steady growth, that's far more desirable than this 20-30% increase, because it really just gives people some really difficult situations. It's not motivating. Those that are out of the market continue to find that they get pushed further away and displaced from their communities. So yeah, look, I think the reduction in values is probably a good sign for those borrowers that have been left behind and struggle to get in the market during the pandemic. Now, we also see the forecast for 2024 with that slow and steady growth of 5 to 6%. I, once again, don't think that's a bad thing. Sydney and Melbourne, Brisbane, all set to have similar sort of growth in the rest of the country. So I think definitely interesting to see how that plays out and what goes on there. We talked about, the previous growth. So in 2021, we saw property values in Sydney, Melbourne, Brisbane increasing around that 25%. Definitely not sustainable. So to see that starting to slow down and get a little bit more realistic is certainly something that is good news. I think with the boom, we saw a bunch of suburbs that are currently starting to find that the values are starting to go down. So we saw that with the top end seaside and treeside areas along the east coast of Australia. They actually doubled, and that was from trough to peak during the pandemic period as buyers sought safe havens. And now some of these suburbs that posted massive gains, they're actually facing double-digit drops as fears about the pandemic are replaced by concerns about inflation and the falling stock market. Now, what we've seen, the significantly impacted areas are the high-value housing markets and the areas that have holiday homes, and yet they're more discretionary assets that are being sold off. So if we have a look at somewhere like Sydney, we can see some of these suburbs recorded 50% increases in value, which is absolutely insane. So to see them go backwards, so somewhere like Newport going backwards by 10%, if you've had your property for more than 2 or 3 years, is that really a bad thing? I don't really think so. I mean, yeah, sure, if you bought in the last 12 months and you bought at the peak, going backwards that's definitely going to hurt a little bit. But we can see these upper end of suburbs, Tarrant Point, once again, going backwards 16%. And then other areas in Sydney all predicted to go down. We saw the same thing in Brisbane, areas like Hawthorn, 69% growth during trough to peak change. That's just huge. And that's an area that's been set to come off the boil a little bit. Once again, 7% is measly compared to the growth that they've seen. We saw some great growth in Pollara. Definitely had a lot of clients of ours that built out there back, 2 to 4 years ago. And the growth they've seen out there is just magnificent. So to go off by 1.7%, I think that's not a huge deal. We can see most of Brisbane isn't set to reduced by all that much from peak to trough, but obviously areas that are potentially going to come off the boil a little bit. And Melbourne, mainly the Mornington Peninsula, St Andrews Beach, from a peak of 63% down 6%. Same thing here. We're not seeing massive double-digit reductions, but definitely reductions nonetheless. So guys, that's it for today. If you have any questions, leave a comment below. And as always, thanks for watching.